Roth versus traditional IRA. Every personal finance channel covers this topic. But I've never seen anyone give you a clean, usable decision tree, the kind where you answer 3 questions and know definitively which account to open. That's what this video is. After this, you will know exactly which account to use right now. And I'll tell you when to switch. Welcome back. The Roth versus traditional debate usually gets reduced to pay taxes now or later, and that framing is correct but incomplete. The right answer depends on your current marginal tax rate, your expected retirement tax rate, and your time horizon. In this video, I'll give you the full framework, the 2026 income limits, the backdoor Roth for high earners, and a specific decision tree you can apply to your own situation. Both accounts let your money grow tax deferred. The difference is when you pay taxes. Traditional IRA *, you contribute pre-tax money. The contribution may be tax deductible depending on your income and workplace retirement plan access. Your money grows untaxed. Withdrawals in retirement are taxed as ordinary income. You're deferring the tax bill to the future. Roth IRA *, you contribute after-tax money, no deduction now. Your money grows completely tax-free. Qualified withdrawals in retirement are completely tax-free. You're paying the tax bill now. The math question is simple: will you be in a higher tax bracket now, or in retirement? If your retirement tax rate will be lower than your current rate, traditional wins, you defer taxes from the higher bracket to the lower one. If your retirement tax rate will be higher than your current rate, Roth wins, you pay taxes now at the lower rate, never again at the higher future rate. The complication: nobody knows their future tax rate with certainty. Contribution limits for 2026 * $7,000 per person, $8,000 if age 50 or older. Same limit for both account types, it's a combined limit, not separate. You can split between Roth and traditional, but the total can't exceed $7,000. Roth IRA income limits * you can contribute the full $7,000 to a Roth if your modified adjusted gross income is below $150,000, single, or $236,000, married filing jointly. The contribution phases out and is eliminated above $165,000 single / $246,000 MFJ. Above those limits, you cannot contribute directly, but there's a workaround I'll cover in a moment. Traditional IRA deductibility * anyone can contribute to a traditional IRA regardless of income. But the tax deduction phases out if you or your spouse have a workplace retirement plan, 401k, 403b, etc., and your income exceeds roughly $77,000 single / $123,000 MFJ. Above those limits, your traditional IRA contribution is non-deductible, meaning you contribute after-tax dollars but don't get the deduction. In that case, the tax advantage largely disappears. This deductibility phase-out is the hidden detail that changes the math for many middle-income earners. Here's the decision tree I use. Answer these 3 questions in order. Question 1: do you have a 401k or other workplace plan? If no, you can deduct traditional IRA contributions regardless of income. Go to question 3. If yes, deductibility phases out at the income levels above. Go to question 2. Question 2: what is your current marginal tax bracket? If 12% or below, under $47,000 single / $94,000 married, you're in a low bracket now. Pay taxes now at the low rate. Open a Roth IRA. If 22% or 24%, $47,000 to $191,000 single range, this is the contested zone. You're paying a meaningful rate now. If you expect a similar or lower rate in retirement, especially with Social Security income, lower expenses, and no mortgage, traditional may edge out Roth. If you're early in your career and expect your income to grow significantly, Roth still wins. Most people in this bracket do well with Roth. If 32% or above $191,000 single, you're in a high bracket. Deferring tax is usually the right move. Open a traditional IRA, but check: does your income exceed the Roth deductibility limit? If yes, you're in backdoor Roth territory, see question 3. Question 3: do you exceed the Roth income limit, $165,000 single / $246,000 MFJ? If yes, you can't contribute to a Roth directly. But you can do the backdoor Roth, covered next. For high earners who exceed the income limits, the backdoor Roth is the workaround. Step 1. Open a traditional IRA. Make a non-deductible contribution up to the $7,000 limit. Step 2. Wait a few business days, then convert the traditional IRA balance to Roth. Since the contribution was non-deductible, after-tax money, you owe taxes only on any earnings that accrued in the brief period between contribution and conversion. If you convert immediately, the tax is essentially zero. This is completely legal, the IRS is aware of it and has not moved to eliminate it. You report the conversion on Form 8606. The pro rata rule warning asterisk: if you already have other pre-tax traditional IRA funds, the IRS calculates your tax owed on the Roth conversion proportionally across all your traditional IRA money, not just the new contribution. If you have $100,000 in a pre-tax traditional IRA and add a $7,000 non-deductible contribution and convert it, you owe taxes on approximately 93% of the conversion. This can create an unexpected tax bill. The solution: roll your existing traditional IRA funds into your employer 401k first, which removes them from the pro rata calculation. People often ask, once I pick one, am I locked in? No. You can convert traditional IRA money to Roth IRA at any time. This is called a Roth conversion. You pay ordinary income tax on the converted amount in the year you convert. The strategic move: Roth conversions during low-income years. If you retire early before claiming Social Security, you may have years with very low taxable income. Converting traditional IRA funds during these years, filling up the 12% or 22% bracket at below normal rates, permanently moves money into tax-free Roth territory before you're required to take RMDs, required minimum distributions, at age 73. This is called a Roth conversion ladder, and it's one of the most powerful tax planning tools available to early retirees. Conversely, if your income spikes in a given year, big bonuses, business sale, property sale, you may want to pause Roth conversions or switch contribution strategy that year to avoid being pushed into a higher bracket than necessary. Here's the quick decision rule: if you're under 40, in the 12% or 22% bracket, and haven't maxed a 401k already, Roth IRA. Open it today. If you're in the 32% plus bracket and have access to a deductible traditional first, then consider a Roth conversion ladder in lower income years. Fidelity and Schwab both offer excellent, free IRA accounts with zero minimums, access to all major index funds, and automatic contribution scheduling. Links are in the description. Takes 10 minutes to open. If you want to optimize the tax side, especially around Roth conversions, I've linked a TurboTax guide on Form 8606. That's the form that matters for backdoor Roth reporting. Subscribe for 2 videos a day. Comment, which account are you using right now, and does the decision tree point you towards something different?